I'm delighted to have with me Noel Sobelman, an innovation process consultant with whom I've had the pleasure to collaborate with in many ways over the course of my career. For the past 25 years, Noel has worked in the areas of growth strategy, innovation capability building, portfolio management, organization design, and digital enablement. Noel, thanks for joining me today.
Thank you, Brian. It's great to chat.
So I'd like to begin our conversation asking about your successful career in innovation, both as a practitioner and as an advisor for some of the world's most successful companies. I'm curious, is there a common through line that you see regarding what companies do, regardless of their size, to consistently grow through innovation and product development?
Yeah, good question, Brian. Yeah, I think leading companies, well, there's really three things that come to mind. The leading companies, first of all, they recognize that excellence in innovation and product development is a sustainable competitive advantage, and they continuously work at it to improve year over year. So building these capabilities and continuing to improve them is a competitive advantage in of itself. Secondly, related to that, is they recognize that innovation, product development is this interdependent system. You might improve your gated development process, and that might only take you so far. But there's also strategy, there's portfolio management that connects strategy to execution. There's innovating in the core where there's more known in terms of what your customer needs are and what your technologies you're working with. There's also innovation in further away from the core where there's more uncertainty. You're going into new markets with transformative new solutions or new business models that require a different approach to innovation. There's the technologies that I'm sure we'll talk about. There's the reward systems. There's open innovation. How do we work with our partners to innovate and leverage the ecosystem in order to deliver solutions? So I think companies that understand all those different moving parts and that reinforce one another are able to really transform themselves, because they don't just focus in on improving one area. They're always trying to improve all the different elements of that system that's so interdependent. You can improve one and it only takes you so far. If you work on all of those elements over time, you start to see that transformative change. And then I think the final thing I'd highlight from the companies that do this really well is they just have this relentless thirst for discovering and really understanding their customers and their customers' problems. They understand those important underserved needs or jobs and translate them into viable solutions in a systematic way. They're just passionate about their customers.
Yeah, that makes a lot of sense. This combination of the discipline and this kind of broad view of all the requirements that go into successful innovation applied toward that passion around customer problems and problem orientation. I think that makes a lot of sense. One of the things I've always appreciated about you, Noel, you're a great author. You've written some very insightful pieces about innovation, and the one thing that I'd like to discuss with you is this paper that you've just published on our BrightFire blog, in which you reflect on some of this transition that companies have to go through from what you call this from early stage portfolio maturity into what you call dynamic portfolio management. And I wonder if you could just share a little bit about what does that mean? What's the difference between those two stages?
Yeah, there's this life cycle of maturity. In the early days, when companies are starting out with this discipline, it's typically characterized by periodic reviews. Typically, it's an annual review process where project data is gathered, from individual project spreadsheets, and then you're manually pulling that data together, prioritizing your projects, understanding where the capacity line is, and then figuring out what funding decisions to make. So it's a very manual process, and it's very static, meaning I'm working with one company right now as an example where they have a very well defined annual operating plan process and then a long range planning process. So they set their project priorities at the beginning of the year, and then they execute on those project priorities throughout the year. And if projects aren't finished, they carry over to the next year, and so on and so forth. But what's happening is markets are changing much too quickly. So in this case, this company wants to get into more digital, smart solutions, and the pace of change in their markets isn't what it used to be. So they're realizing that they need to pick their head up and look around throughout the year and be more and have more of a dynamic capability to make mid-year course corrections to where they're putting their investments, their scarce resources, how they're allocating them. So the early stage companies, that data collection is very time consuming. It can take weeks for some companies. The data is often not kept up to date. And then there's also inconsistencies with project financials, and decision-making rules aren't well defined, or they're informal. And there's a lack of objective evaluation criteria for even prioritizing projects. So when companies get really good at this, well, first of all, when they grow, they reach a point where they outgrow the utility of these disconnected spreadsheets that house the information. And that's where they recognize that they need some tools that allow them, or a common database where they can look at their project information, their portfolios, real time. So that's that shift they make from early stage to what I'm calling dynamic portfolio management in that article. So dynamic is that always on real time process. As long as the project teams are keeping their project information up to date, including market information as well as project progress, then at any time, at any place in the organization, you can take a look at what's going on with your portfolio and your individual projects and make decisions. So it's that shift from static to dynamic portfolio management that you really see a step function change in improvement in managing the pipeline. And then when you get to that point, you're able to take a look at things like portfolio balance, the value of your portfolio, risk, strategy alignment, your resource supply demand. You can do that real time, and you can do things like it opens up that visibility where you can see where the constraints might be in your pipeline, and you can be more proactive with regard to resolving those constraints because you have the information. And instead of being reactive and firefighting when you have a bottleneck in your pipeline, you can see those in advance and act on those and make decisions appropriately, whether it's to resequence the priorities of your projects, or maybe outsource to get more to flex capacity for any bottlenecks in the pipeline. It's that proactive decision making that really helps companies improve their overall throughput, in addition to hitting their financial goals.
One of the things that I really appreciated about your perspective in this paper, so you outline these 4 different dimensions of value, like between that before and after. Kind of explain a little bit about the why this matters so much. Maybe would you mind just elaborating a little bit more on that? I mean, how would you characterize those benefits of moving from that one plane to the next?
Yeah, sure. So when you're going from that static portfolio management early stage that we talked about to this dynamic portfolio management. So one area is in portfolio reporting. Again, you're going from a periodic or event-based where you're gathering the data and pulling together the reports to having it be under dynamic portfolio management. It's on demand. It's as long as the teams are keeping their data up to date, you can run all kinds of different what if scenarios and understand. So the reporting aspect is greatly improved when you get to that stage. Data gathering, going from manual gathering off of disconnected spreadsheets or various sources. A company I've been working with, they have spreadsheets, they have multiple systems in different business units. So when they pull together the data, lots of apples and oranges. So just the process of pulling the data together is very painful, and it can take literally weeks to prepare for a review, as opposed to when you really get to that dynamic state, it's always available. It's in the format you want in terms of how do you view your portfolio. And you have that data integrity, which is the third area. So making sure you have going from inconsistent data that's not updated frequently enough to accurate, up-to-date data is the other shift from. And then finally, that's just when you go from this early stage static mode that I've been describing, there's typically a high administrative burden. I mentioned it's very manual. You're pulling data from these disconnected sources, but the goal really needs to be to lower that administrative burden, and that's where I think technology has done a lot to help companies. I mentioned a common database where everybody views the information, and it's always you can trust that information. It's that one source of the truth model. So going from high administrative burden to prepare for a review to a low administrative burden, and then as long as the teams are continuing through their development process, as any change that happens in the marketplace or any change that happens in the project, they're just making sure their data is up to date. So you can always at any point in time, take a look, and it's not very painful to pull that data together. So those are really the main areas that really highlight the differences between the early stage and the more dynamic approach.
One of the areas that we are focused on is are these kinds of companies that are a little bit more medium-sized or sometimes less mature, CPG or food and beverage companies, many of whom haven't yet made that transition that you've just articulated. And I'm curious for your opinion on how these particular kinds of not so big companies can be more successful in making that transition.
Yeah, I think the benefits of dynamic portfolio management have more to do with the pace of change in your markets, the number of products in your pipeline, the life cycle of your projects, and the degree to which you're sharing resources across different product lines than it does company size. So, for example, in fast changing markets with changing priorities or changing consumer buying behaviors, that will require more frequent re-examination of your investments. Also, when there's are lots of products or brand extensions in your development pipeline, that also brings a level of complexity to those strategic and operational decisions. And then when you're dealing with short life cycle products, that means that your portfolio is constantly changing over, and the new offering vitality needs to be dynamically managed. So, maybe this is an extreme example, but let's just take like an ice cream company as an example. If my only offerings are chocolate, vanilla, and strawberry, and my target market is seniors who are pretty set in their ways in terms of their preferences for flavor, contrast that with a company that has 32 different flavors, maybe like a Ben and Jerry's. They're introducing a new flavor every quarter to a fickle mass consumer market. The difference in needs of those two portfolios are tremendous. So those are the characteristics that I think you should think about when making that shift. Now, there are advantages of smaller companies, meaning I work with a lot of large companies with business units that are the size of the Fortune 500, and they're all. So you have multiple higher levels of hierarchy to figure out how are we going to govern all of this information. At what level are we going to make decisions about investment and resource allocation, and who's got the decision rights? When you're in a smaller company, that's relatively straightforward. So you can get started, and then you can layer in some of these advanced capabilities over time as you grow. So I think there's a little bit of an advantage when you're small to get started and implementing some of these capabilities and providing the needed decision-making governance.
One of the other areas that we're passionate about is around the use of innovation pipeline technology. But how might technology aid in that? And what are some things that companies might want to also watch out for when it comes to technology?
Yeah, I think technology is one of the keys for making this transition to becoming more dynamic. That's the common database that I was referring to earlier. So when you have all that information in one place, it allows you to do the analysis. But in terms of your question about some of the smaller or less mature companies, I think as long as you're not automating poor practices, I think you can leverage systems like BrightFire, PPM systems that these days have leading practices built into their base out-of-box configuration. So the implementation of the technology can almost be viewed as a catalyst for maturing your capabilities when you're small and early stage. So you can take this parallel approach to improving when you're smaller. I think there's a strong argument that says you don't need to wait years and years to perfect your process. You can get started. Just the big watch out though is make sure you're not automating those poor practices. Of other watch outs, I would say just avoid that complexity. These technologies, these PPM solutions, as you know, Bryan, they have many potential features and benefits. But if you take on too much too soon, you're introducing complexity to the organization. My recommendation is always to take a get started and get better approach to technology. Start with get the foundational elements in place, start working the processes, make sure that the tool is being used for its intended purpose to make decisions, not just create reports. And then over time, you can layer in that those advanced features that most of these solutions have. And I think more than anything, my biggest watch out is that just don't underestimate the importance of organizational change management. You can argue that the processes or the capabilities and the tools we've been talking about, that's relatively easy. The hard part in portfolio management is you're changing behaviors. There's a discipline. And if leaders who got to where they are by, they have to take a hard look at what are some of the messages that they're sending the organization. If you're not saying no to anything, then you shouldn't be surprised if you have chronic bottlenecks in your pipeline and projects delivery is unpredictable. So it's about managing for throughput, not loading to capacity. And that takes leaderships to act with this information that they now have and make more informed decisions about what not to do in order to improve overall throughput, as an example. So just making sure that you think about the behavior side of this. Pay attention to behavior change. Make sure you're articulating why we're doing this to your employees. Answer the "what's in it for me" question, and just continually reinforce why you're doing this.
Maybe a way to just kind of encapsulate a bit of what you just said is this idea that for these kinds of companies, for these not so big, medium-sized, less mature companies, yes, they do need to operate and move at a pace of change that is unique, I think, to companies of that size. But if they go into this with a mindset of this is a technology initiative that we're going to implement in order to solve this, that's in a weird way, that's the wrong mindset for this. Ultimately, people have to view this as a business process transformation that they're engaging, that they're moving into. The technology is just enabling that. And as long as they stay focused on that, where they're headed from a business process evolution standpoint, they can be successful. So it's this forest for the trees kind of watch out that I think a lot of companies need to pay attention to, regardless of what size they are.
Yeah, well said. It's a business discipline. The tool enables that process. Absolutely.
Well, Noel, thank you so much for spending some time today. Really find your insights valuable as always. Really appreciate it. Have a good rest of your day. Thanks again.
You too, Bryan. Thank you.